When I ask you about the stock market, what's the first thing that comes to your mind? Now, if somebody would have asked me 10, 15 years ago, what do you think about the stock market? The first thing that would come to my mind is gambling, a rigged system for the wealthy, not for me. When the truth couldn't be further from that, and I'm going to actually try to help establish that for you guys here today. Only about 50% of Americans are investing in the stock markets now, whether that be through their IRA, retirement, Roth, or an individual brokerage that they invest in stocks in for themselves. Why do you think that is? The main reason for that is because most of us don't want to take the time to learn about investing and the benefits that it can have for us. So, it seems very intimidating when you think about, you hear about S&P 500, NASDAQ, Dow Jones, and you hear about the bulls, the bears, and, Wall Street. And, it's all very overwhelming when if you take some time to look into it, it actually makes a lot of sense, and it can be very beneficial, especially when done long term. And we're going to talk today about how to capitalize from the stock market for long-term investors, and how to get started and everything in. So, guys, this video took me a long time to prep. So, all I ask from you guys is that, just hit that like button and make sure you guys subscribe to the page. Took me a long time, and we're gonna jump right into it. Action-packed video. Grab yourself a drink, get yourself something to eat, sit down, because I got a lot of slides that are prepared for this one. So let's jump right into it. Hold on 1 minute. There we go. All right. So Americans buy about $100 million a year in lottery tickets. Now, who do you think is buying lottery tickets? Mostly it's the lower middle class to all the way to the poorest of the class, the poorest people in the country that are buying most of these lottery tickets. Now, why do you think that is? When somebody has no options and they have nothing to lose, well, they're going to try to go for, they're going to try to hit a home run. They're going to try to hit a home run every single time. So they're not really focused. When you don't have much and you don't have anything, they're not really focused on, how to build wealth over time. They're focused on trying to get rich quick. And if that's what you're trying to do in the stock market, you're going to fail miserably, because this is a long-term game. And the people who try to jump in and out, these are the people who 90% of the time, or maybe more than 90% of the time, are unsuccessful. So today we're going to talk about the stock market and long-term investing. So I made a video recently on stock market returns versus real estate returns, and I got a lot of people commenting and reaching out to me and saying that, hey, can you make a video more in depth about how to get into stocks and in stocks? So I said, you know what, let's do that today. So we went ahead, prepared a bunch of slides for you guys. So just hang tight and bear with me, guys. I know this is, right now everyone is into shorts. It's evident from my channel. I make long, nice, in-depth content with gems. I drop gems in those videos, automotive related mostly, and they don't get much views. And then I do a idiotic, stupid short, and it gets 30, 40,000 views within a few days. So, that's just kind of the state of events that's happening, with humanity nowadays, with people. So, guys, just bear with me a little bit. This video is going to be very beneficial for you. So let's jump right into it. So, what is a stock? I'm going to start by the basic definition of what a stock is. A stock is a unit of ownership in a company. If you own a stock, that makes you a shareholder, meaning that you are eligible to receive a dividend if the company succeeds and decides to pay them out. Also, you may vote in some company decisions. So effectively, if you even own one share of any public company, you're basically a part owner of the company, you could say. You actually have ownership of the company. So I'll give you a quick example of this one, something we all know, Apple. Now, this is the closing price for Apple as of Friday. So it closed at $193. So the price for one share of Apple right now is $193.05. So if you just buy one share, technically you have part ownership in Apple. So many companies are, they have that are public. They have their stocks, so you can buy stocks in the companies that, many everyday companies of things that you use, you can buy their stocks. So this is the example for Apple. So now, moving on to the S&P 500. So now, what is the S&P 500? So the S&P 500 is a composite of the 500, you could say, biggest companies in the U.S. As of the companies go in and out, but this is the top performing 500 companies, the big dogs of the U.S. economy mostly. So you can see here that this is the performance since 1980. So you can see since 1980, you can see that this is how much that they have grown. The S&P 500 fund has grown. It's grown per year. So you see here 25%. Now you can see here there is positive years and there's negative years. So you can see overwhelmingly, just overlooking it, seems that there's more green, obviously. But there is also red in here, so it's not to say that if you just invest in the stock market, it's going to be upward all the time. There is also times in years which it was a negative year. You lost the overall market was down on that year. Recently, the one I could think of was 2022. It was down 19%. That was it was a pretty bad year. It was coming off of the highs from COVID and everything when everybody had stimulus money. So 2022 was it was a pretty good correction on that year. But aside from that, you could see for the most part, the stock prices and everything has been going up, and overall, the market it gains anywhere from 7 to 10% on average per year, and this is just the S&P 500. So many people, they'll prefer to buy the S&P 500, which is the index, which includes most of the major companies, rather than to buy individual stocks. When you buy the whole index, you're diversified in your portfolio. You have everything, all different sectors, all different type of companies, different industries, and it's completely diversified. When you're buying individual stocks such as Apple, well, now you open yourself up for more risk, but possibly open yourself up for a lot more reward as well. The reward is a lot higher. It's a lot higher possibility for reward. But many people choose just to go with the indexes, which is fine. Now, for the S&P 500, for my Muslim viewers, there's obviously companies in there that are impermissible, such as they sell adult entertainment, alcohol, and impermissible things like that. So there's also different indexes that you can do that are Sharia compliant, like SPUS. Amana has a few. There's a few different ones out there that you could do, which basically takes all of the permissible companies and puts them all bunched together into one index. So now moving on, there's 5 types of stocks. Now, number 1 is a dividend stock. Now, a dividend stock provides a stream of income in a form of a dividend. For example, AT&T. So basically, they have a percentage of that they give a dividend. Now, the dividend is usually paid out, quarterly. So based upon how many shares you have, you will get a dividend percentage based on the shares. So this is a good way. A lot of people are dividend investors. There's growth investors. Now, growth investors are, high growth rate is, okay, growth stocks are high growth rate with increasing cash flow. Example is like Netflix, Nvidia. You could say like, the Magnificent Seven. Those are all, ones that are, they grow a lot. Like Nvidia is a top company this year. It grows a lot. So, you have really big upside potential if you just invest in these stocks. But again, you open up yourself to more risk if you want to go with the individual stocks. Now, defensive is low correlation to overall stock market. For example, Walmart. These are kind of safety plays. People who just want to, hide some money out. They go to Walmart, a Costco, those kind of stocks. Then we got blue chip. So blue chip companies with an excellent reputation of earning. For example, we got Microsoft, you got Nvidia, you got these type of companies. And you got cyclical companies whose success follows the economic cycle. For example, Zillow. So these are the different types of 5 basic types of stocks. Now, first we talked about the indexes, which is the S&P 500. And that's a broad index which basically bunches everything together. Now, you can also invest in individual stocks, or you could do a mixture of both. Now, I personally chose to do a mixture of both. Most of my money is in individual stocks, but if you go this route, you have to. It's not really necessarily a hands-off approach. You have to look into the companies, and you have to be a little bit more involved. Whereas if you just put your money into an index, you could just kind of leave the money and kind of forget about it, set it and forget it. But if we just look at, this is 2023 returns for these companies. Now, these are crazy returns. I mean, this is not some penny stocks because, that are high risk stocks. I mean, these are everyday. Nvidia, they make all the chips. Meta, Facebook, everybody knows that. So look at Nvidia, 239% return in 1 year. I mean, that's amazing. That's crazy returns, honestly. Mind-blowing. Meta, 194%. Tesla, 102%. So, I mean, look, if you would have put just say, $10,000 into Tesla at the beginning of 23, by the end of 23, that 10,000 was over 20,000 because it's a little bit over 100%. So, just thinking about that it's really amazing, honestly. Amazon was up 81% for the year. Alphabet, which is known as Google, was up 59%. Microsoft was 57%. Apple was 48%, and the S&P 500, which was the broad index we talked about, was 24%. So you see the 24%, which is still an excellent return on your money. In my lifetime, treasury bonds, saving accounts, that's what most people be like, okay, let's put your money into a saving account, which we don't find that, we're not comfortable doing that because of, permissibility wise. But as of right now, in the last, as long as I've been alive, in the last 3 decades, right now the bonds and treasuries and saving accounts are yielding around 5%, which is the highest it's been in 3 decades. So if you look at that, if you even compare 5%, which I'm telling you is the highest, it hasn't been almost nothing for decades. And now, since interest rates are so high, we have the over 5%, around 5% with their yielding. The S&P 500 still, just if you wanted to just go completely safe and play it safe and put your money into the index, still 24% return on that. So that's very good returns. Now, if you wanted to go a little bit more, you can't even call it risky, to be honest with you, because again, these are top of the top companies in the world. And look at the returns that you're getting. Of course, this is not going to be every year, but 2023 was a really good year in the market. So you can see that these are some of the returns that you got. Now, let's talk about different types of investing. So we have passive investing. So what is passive investing? The overall goal of passive investing is to build wealth gradually. Also referred to as buy and hold strategy, passive investors focus on long-term plan and don't profit from market timing and short-term market fluctuations. So a long-term investor, when they get 100% return in 1 year, well, some of them might take some profits, but they're holding out for the long term. Their vision is 10, 15 years out. They're not looking at the short term. Now, what is an active investor? An active investor involves real-time buying and selling and is intended to build wealth quickly An active investor or portfolio manager constantly monitors the stock market and trades shares when the opportunity arises. So, I mean, I'll be honest with you, I would not recommend this for any beginners. Trading is, something that's very risky. I personally do not engage in any sort of trading. I'm completely long. So that's the only game that I play. So what is a buy and hold strategy? The buy and hold strategy is popular long-term investment where you buy and hold stocks and other securities and hold on to them regardless of changes in the market. So you ride the waves on this one. Long-term is when you are just riding the wave. Now, let's take a look at this one. This is really, really, this chart puts everything in perspective for me. So now, you think about the stock market and the volatility and, things going up and down and, people are like, oh, I got to sell. I got to get out of the market. Then, things start going, well, I got to get back in the market, and they're jumping in and out. It's like, again, like I said, it's a clown's game. Not many people can play it well. Long-term investing is much more safe, and, it's a better route to go. Now, let's just look at this. There's always reasons to not invest, but the S&P 500 has returned 10% per year on an average since the 1950s. Okay, so imagine, the money that you have in your savings, you get 10% on that compounded. Now, we're going to talk about compounding a little bit later on, but it's not just 10% you're getting one time. It's 10% every year. Your money is increasing, and that snowball keeps getting bigger and bigger and bigger. Let's just talk shortly about some major events in our history. This is major events in U.S. history and what happened with the stock market and the short term and the long term. So now let's look at this. JFK killed. The President of the United States gets assassinated on TV. There's videos of it. Can you imagine? If something terrible like that were to happen, you would think that, the economy's done, the country's done. What's going to happen? What's the future? So now you can see here, we get a little dip right here, which I'm sure at the time was very significant. But then you look, the trend keeps going up. Then we had the Vietnam War. Oh my God, World War. Bam, it goes down. What happens? Eventually it goes back up. Then Nixon resigns. The President of the United States resigns. Can you imagine? Market crashes. Eventually what happens? It keeps going up, keeps going up, keeps going up. So let's skip a little bit to our lifetime so that some of these might make a little bit more sense. All right? I was alive for this. The dot-com bubble, Y2K. I remember Y2K when I was like maybe 10 years old, and everyone's like, oh, 2000, when 2000 comes, the world's going to end, blah, blah, blah. And so we got a little bit of a dip. And the dot-com bubble was vicious, actually, if you look at it. But it's just a blip on the chart. In the long term, when you just zoom out, it's just a blip on the chart. And the chart keeps going up. September 11th. Come on. The worst attack in U.S. history on our soil. You would think that, we're going to go into World War, economy is never going to come. They attacked the financial capital of the U.S., New York. You would think that it's never going to come back. And it did. It dipped for a while. It did. But look, eventually it kept coming back. Now, 2008, this is the year I graduated high school. The great financial crisis, the housing crisis, the bank crisis. And that was a vicious... And I remember getting laid off from my first job because the economy was so bad. And, nobody had money. It's funny for me because when you're broke, it doesn't really matter what the economy is, right? Because you're broke, it doesn't matter. I was just getting into the auto industry at that time. I got my first job, so I got laid off, and everything around us was crumbling. But we're just young kids, and 18, 20, 19 years old. It doesn't really matter when you're broke. The economy doesn't really matter too much, right? So, anyways. Then it just kept going up. Now, this is the most recent COVID. I remember when this happened. COVID, was 4 years ago. Such a vicious crash that, you would think that nothing is going to, ever recover. Talking about the economy being shut down for 2+ years and all kinds of stuff, So the market crashed. But look at it now. A new all-time high. So what's my point of telling you all this? At any of these points... Think about if you had inside information the day before COVID was announced and became serious. It was like around March 14th when the market sold off, March 15th, 2020 when the market sold off, somewhere around there. and you just had inside information like, hey, Fauci just told you like, hey, it's going to sell off tomorrow, and you're like, oh shoot, okay, let me just sell all my stocks, and you sold your stocks, and the next day, in the next preceding few weeks, the market just sold off, and you're like, wow, I'm the smartest person in the world. I timed the market perfectly, and I got out, and now the market crashed. And just say you stayed out of the market. Well, now look where the market went. I mean, just within that year, it was actually a great year because the market, there was stimulus, everybody was back in the market, and look to where it is today. It would make no sense. So to buy and hold for the long term, don't get caught up in the news, don't get caught up in all of the things that are going on. Buy and hold for the long term. It's all of it, regardless, is it doesn't really matter in the long term, because inevitably the trajectory is upward, always upward. Excelsior, like the state I'm in, New York. More than likely, this eventually it's going to recover. It's going to go up higher and higher and higher. Hey, it could change, but this is from 1950 to today, and that's been the trajectory. So likely this is what's going to continue as well. Not guaranteed though, right? So investments, the U.S. stock market volatility can be intimidating, and while past performance is not a guarantee of the future, as I was saying, the history shows that the market has been able to recover from declines and still provide investors with positive returns long term. In fact, over the past 35 years, the market has posted positive annual returns in nearly 8 out of 10 years. 8 out of 10 years, you're getting a positive return on your investment. All right. When to invest in stocks. A buy and hold strategy can help investors avoid missing out on the biggest days in the market. The hardest part about choosing when to be in and out of the market is that missing a few key days or weeks of a 5-10 year cycle can significantly influence or on your returns. Historically, a large share of stocks gains and losses occur in just a few days of any given year. Since the pattern of returns isn't predictable from a month to month, a consistent long-term investment can add to your bottom line. All right. So growth. Well, we're going to talk about compounding now. So when you grow with compounding interest. A buy and hold strategy can also help investors take advantage of compound interest. Now, interest here is not talking about the interest from like interest-bearing loans. We're talking about profit. That's what they're referring to as compound interest. So just keep that in mind. While the past performance is not a guarantee of future, the S&P 500 inflation-adjusted annual average return is about 7%. This means, on average, the index value is 7% greater at the end of the year than it was at the beginning of the year. These gains accumulated over time can provide advantage to those who start long-term investing early. An early start versus stock market timing. Investors often try to wait for the right time to start putting money into the stock market, but the longer they delay their investment, the longer they miss out on company dividends and profits as well, and just compounding. And we're going to see an example of that in the next slide here. So here, this is an example to show you the earlier person takes advantage of compound interest, the more time the money has to grow. Okay, so investor number 1 starts at 25, and they set aside $5,000 a year for 10 years in a row. So 10 years from 25 to the end of the 30, so 25 to 35 basically, they invested $5,000 a year. So that's all that they invested. So their initial investment, and no more after the age of 34. Okay. And then investor number 2 starts at 35. So they had a little bit of a later start. Invest $5,000 each year for 30 years in a row until they reach 65. So you can see the difference now. Then that's the compounding. So you can see that she just invested, for 10 years till she was 35, and then never invested again. Whatever she had, she just let it roll. And the snowball just kept getting bigger and bigger and bigger. Let me give you guys an example of this so that you can understand it better. So if you have, let's make it simple. Let's say you have $1,000 that you invest, right? And let's just say the market goes up on that given year 10%. So on the 1,000, now at the end of the year, you're going to have 1,100, correct? So now the next year, just say it goes up another 10%. So it's not going to be 10% of 1,000 now. It's going to be 10% of 1,100. So you can see how the snowball keeps getting bigger and bigger and bigger, and eventually it's just going to become massive. So she invested $5,000 a year, right up to the point where she was, right before she's for 10 years, okay, right till she was 34, at the end of 34, and then after that she just let her investment grow through compound interest, and by the time she was 65, her net worth in her portfolio was $787,000. Now, investor number 2, he invested for 30 years. So he had, just because of the 10-year delay from when he started investing, he had to invest 20 additional years, and he still underperformed investor number 1. So that just shows you how important it is to get started when you're young. I can't stress this enough, I think it's an East Coast thing. Everybody here is, everyone is skeptic here. Everyone here is a skeptic. If somebody tells you something, you're going to think the person is trying to sell me something. He's trying to play me. He's trying to do something. He's a Ponzi scheme. And, everyone's skeptic. Nobody wants to actually listen to somebody and to take it at, to do their own research. And I wish, honestly, someone would have had this conversation with me when I was younger, so that I would have gotten started earlier. But that's neither here or there. It's never too late, and you can always, benefit from investing. It doesn't matter how old you are. All right. So impact of compound interest over time. So assuming a $500 monthly deposited, and you get 5% on your money. Okay. So you're investing $500 into your stock portfolio, whatever it is. It could be individual stocks, it could be the index, okay? But you're getting 5%. Now, 5% is a very, very conservative. You should be able to get more than that in the market, okay? But that's very conservative. You just get you're doing $500 a month, okay? And you get 5%. So after 10 years, you've put in $60,000 after 10 years, okay? That's how much it totals out to, all right? But you have earned $17,000. That's your annual return. How much it's and plus the compounding over time. So after 10 years, you're at $70,000. After 20 years, you can see when now the snowball is getting bigger and bigger and bigger. So now you have invested merely $120,000, but you're up to $205,000. 30 years is $416,000, and 40 years you're at $763,000 of your initial $240,000 investment, and this is invested over time. So you're catching the highs, the lows. You're basically dollar cost averaging into the market. So you could see, you're not getting those kind of returns anywhere else. Where are you going to get that kind of a return? It's over a 2x, almost a 3x return. Here's another example. So basically here, this is showing, now we're talking now about what's the chances of having a positive year versus a negative year. Now this chart here is comparing stocks from 1926 to 2019. And I can tell you from 2019 to 2024, we've had an epic run. Okay? So these numbers are even, this is a little bit of outdated chart, but it's neither here nor there, all right? So now you can see 69 positive years and 25 negative years out of from 1929 to 2019. So 69 positive. So 73% of the time it's a positive year, and 25% of the time it's a negative year. Now, when it is a negative year, let's take a look. So this right here, I can tell you, this minus, so the market lost between 40 and 60% of its value. Now this was the great, of 1929, the depression. So that's a one-off event. You know what I'm saying? You can't even, but it did happen. So it's here. Now 2 years, the market lost 30 to 40% of its value, and so on and so forth. You could see here, 14 years, it went from basically flatlined to negative 10%. Now, majority of the time, the market is right here between 10 and 20%. So 20 years out of them all, you can see the market gained 20%, or between 10 and 20%. And the other years, you can see it's been right around here. So you can see majority of the time, 73% of the time, it's a positive year. All right, so this is just another chart just showing the separate years. So I guess it was 1931, which was the worst year in the market around the Great Depression. And then now you can see here that majority of the years, are in the green, and you can see all the years that, are in the green. All right, guys. So just quick wrapping up the video. I know the video was long. If you guys have gotten to the end of this one, I hope you guys got value out of this, but just going through some quick, 7 golden rules of investing in the stock market. Number 1 is avoid herd mentality. Now, this is when you're just talking about, try to avoid being influenced by other investors, listening to too many people, and your uncle and your the people on CNBC and different people, different analysts telling you to buy this and sell this, and just stay consistent. Now that comes to number 2. Invest consistently. If you want to build wealth from a market, from the market, you need to invest consistently. Moreover, you also need to increase your investment amounts continuously. So you just got to stay invested. Keep investing. Just stay steadfast. Think long term. Most of stocks take at least 2 to 3 years time frame to give you a good return to the shareholder. Again, that snowball effect. It takes time to build up. Don't get emotional. Like I said, we walked you through, all the major events in U.S. history. If you would have sold out of them, just because you got emotional and thinking, it's never going to get better and things are going to get worse. I mean, you would be in a very, you'd be very disappointed. You'd be really upset with yourself instead of if you would have just stayed invested long term. So diversification. So don't just buy one stock. You know what I'm saying? If you're going to do it in individual stocks, have a basket of at least 5 or more stocks. Spread your money out a little bit. It decreases your overall risk. Okay? Never borrow to invest. Can't stress this enough. A lot of people, they don't have much money and they want to grow their account faster, so they use leverage. Don't do it. It's not a good idea. And keep an eye on fees and taxes. So now this is mainly for people who are doing trading, jumping in and out of stocks. They're going to have to pay taxes, and also dividends, you have to pay taxes as well. So guys, hope you guys got a lot of value out of this video. I hope it clarified the market a little bit for you guys, so you guys have a little bit better understanding how the stock market works and how you can benefit long term from the stock market, especially if you have a long runway. Somebody who is in their 40s and 50s and just getting started, not to say that they can't do it, but the runway is a lot shorter than someone who's in their early to late 20s or 30s and getting started. The runway is a lot longer, so they can take benefit from the compounding. So guys, make sure you guys, and if you guys want me to make another video on actually showing how to actually get started, the app that is most simple that I always recommend is Robinhood, because it's the most simple, straightforward app for everyday investors. The retail investors that are just getting started. Super user friendly, super easy, very easy to understand, and you can really increase your understanding using that app. So I recommend that one. If you guys want me to do a deep dive on how to use it and how to buy your first stock, then definitely comment down below and I can make that video as well. If you guys got value from this, make sure you guys drop a comment below, like, share, subscribe. Until next time, peace.